You deal with CEOs day in and day out. How are they addressing the sort of uncertainty we're seeing over the Chinese trade situation?
So first, it's important to understand what uncertainties we're talking about. People often want to talk about it in terms of macroeconomic uncertainty. I think the macroeconomics of the world are genuinely on the more positive side, not the same growth as last year, but reasonable growth. What we've got right now is a period of, beyond the macroeconomics, much higher levels of uncertainty than periods of even a few years ago. Trade in China, all the political discourse and the uncertainty that brings, what's going on in Europe, now the flare-ups in the Middle East and the risk that that produces into the energy part of the economy. And I think CEOs are now living in a world, the inverse of 3 years ago, where people didn't think about the geopolitics. They thought about the macroeconomics. Now people feel pretty good about the macroeconomics, less about the geopolitics. That makes much more of an ability to deal with uncertainty and build resilience into the business model fundamental. And right now that starts with supply chain risk, but also thinking about, how you drive business.
And talk about supply chain quite specifically. You deal with companies who have had China integrated into the supply chain.
Absolutely.
At this point, are they regarding this trade risk as something that's just transitory, as they say, and therefore we're not going to change anything? Or are they saying we have to start looking at Vietnam, we start looking at other places and really restructure our supply chain given what's going on?
I think CEOs right now have to be thinking about a world of uncertainty and having resilience built into their model. And they have to therefore be able to think about different scenarios that play out. You can't know. We don't know how the trade negotiations will play out. If you're a CEO and you just bet on one outcome, it'll all be fine, or it's all going to explode, you're not acting in a responsible way.
So Marvin, what we heard from a lot of companies on conference calls exposed to, say, trade risks is that they're dealing with cost cutting and they're looking at maybe diversifying some of their supply chains, but they're really managing operations, and that's how they were dealing with that margin compression. How much more upside do they get out of those tools? And in which case, then what do they do?
Yeah, I mean, absolutely. So, the supply chain discussion certainly is a very important part of how these businesses ultimately evolve, but it is an intermediate term response. We can't ultimately just turn on new factories the next day. So if these trade tensions continue, if these tariffs kind of come into play, there's going to be either a margin squeeze and or it's going to get passed off to the consumer. And kind of the way the tariffs have evolved, there's more consumer impact this time.
So resilience, everybody's got to be in favor of resilience. It costs money.
Right.
And I guess my first question is, are CEOs sitting on their pocketbooks? That is to say, right now, given the uncertainty, I'm better off not going anywhere. Or are they spending more money to build in that resilience?
I think right now, it's interesting, the conversation that we're having with many CEOs right now is about what we would term advantage in adversity. That we have so many, no one knows if a recession's coming. I'm on the more positive side of that. I think that's less likely, but there's certainly many ways adversity could play out in different sectors of the economy, and how do you build advantage in that? And advantage comes from four elements. Being prepared, understanding where you really stand. Are you likely to be prey or predator if your sector gets tough? What are the opportunities? Preempting. All the data says people move faster to deal with adverse environments, come out the other end better. Growth is the big differentiator of coming through difficult periods in a sector and using it as an opportunity to transform, and in today's world to digitally transform. And that conversation of prepare, preempt, look for growth vectors even when they're harder to find, and where are the transformation opportunities, particularly in a digital world, that's the conversation that CEOs, I think, want to engage in right now.
So if they do, but then to David's point, is it safer to do M&A than it is to try and grow organically at this point?
Actually, it's such a sector and company specific discussion. It's hard to sort of come up with a generic answer. At this point, with equity markets still pretty high, I think the organic growth vector is still the vector most companies are thinking about. But being prepared for what moves would you make if things got tougher, and maybe starting some conversations and starting to make sure you have enough powder available should opportunities arise. Companies start at different places. Some are weak, and they know that if the economy turns down or if their sector turns down, they're going to be vulnerable. Their job is to strengthen themselves, drive productivity, shed underperforming parts of the portfolio, and strengthen themselves. Others go into it really strong, great balance sheets, strong positions, and they need to be thinking about how would they use a difficult period to really build competitive advantage, capture a strong player in a new sector, consolidate parts of their business. And so they should be thinking about what their M&A agenda could be, not to the exclusion of organic growth, but taking advantage of a slower period, maybe down equity markets.
Marvin, we're so focused on China right now because of these trade disputes. Let's talk about Europe, though. We got some numbers out of Europe. Germany, maybe a little more encouraging. We're concerned about German growth, European growth. We also have a European parliamentary election coming. We talk about uncertainty. How does Europe look to you right now? What are the growth prospects? What are the business prospects?
You know, I mean, certainly Germany's numbers took a little bit of a concern off the market. Having said that, I think that there still is a concern about their manufacturing base. You know, the numbers were driven a bit more by the consumer, which was certainly positive. You add Italy and Italian yields, you have the Italian elections, you have the fact that kind of the better numbers that we saw today really didn't move the euro, and the euro has been in this range for an extended period of time at this point. I think Europe still has a lot of wood to chop before people embrace it again.
So then how would you play the widening BTP bund spread?
You know, ultimately, I think that once we get better indications of what the ECB is going to do, and I think one of the challenges for the macro world is that none of the central banks have anything, for the most part, verbally out there in the market. Expectations for the U.S. are certainly negative, but for the most part, there aren't expectations for any moves until you get an idea that the ECB is going to start to stimulate again. I think you've got a challenge with the fact that Italy, during an election season, is going to be pushing this kind of more dovish agenda.
Well, and Rich, Europe seems to be in a perpetual election season. I mean, whether it's a referendum on Brexit, or whether it's France, or
versus the U.S., which we're never in election season.
But there's so much uncertainty, and you see some companies making strategic decisions. General Motors sold out of Opel, and they said part of the reason was Brexit was taking us nowhere fast. As a practical matter, are you seeing companies, U.S. companies and other companies, saying, you know what, right now I think it's okay to go easy on Europe. We're not interested in really expanding there.
So I think it's very important to come back to Europe because obviously, if there's a trade war between the U.S. and China, then that's a drag on both economies. That will get a lot of the focus. If that gets resolved in some way, the biggest challenge, I think, sits in Europe right now. And the political distraction, continual, makes it harder to embrace the real agenda Europe needs to embrace, which is one of reform and encouraging investment and encouraging growth. And they get pulled in so many directions politically, it's hard to do that. Look, I think different companies will come from, certainly Europe, finding growth in Europe is hard. And I think as companies prioritize, again, depending on the underlying strength of their business, it will be one of the places that's more risk of seeing scale back investment. And getting Europe to embrace a reform agenda and encourage investment and a sound energy policy and a bunch of things that can unlock longer term potential. The quality of the workforce is terrific. It's all the things that go around it that make it really tough.
Yeah, but Marvin, is there a distinction to be made between international and domestic-focused companies within Europe? Like for Q1 GDP for Germany came in better than expected because of domestic reasons. And if there is going to be fiscal stimulus, that's not bad for domestic-focused companies. Do you have to distinguish between the two?
Yeah, I think so. I think that stock picking has kind of gone down that route. It is interesting that Europe has certainly dealt with a lot over the last 6 months, or even you could argue the last year, given how weak last summer was ultimately. Equity markets recently have performed fairly well, and interestingly, it's been the industrial sector within a lot of that discussion that has outperformed. So, people are making bets. I don't know if they're wise bets, kind of given the flare-up of tariff and trade talks again. But having said that, people are making those distinctions.
Rich, take Alex's question and take it more broadly. Do you see companies, as they make their strategies, tend to say, let's stay within the borders? That is to say, we're not as interested in cross-border acquisitions. I've heard that of some private equity. So basically, globalization is going away, not coming in.
I think I've talked to some CEOs recently who were in exactly that position, who saw their main opportunities being domestically geared, and there's so much underlying growth here, and there's so much geopolitical and other uncertainties everywhere else. But I think for many businesses, particularly with more global brands and global opportunities, that's a step too far. And this challenge is to de-average the world. There was this talk years ago about a two-speed world. We're so far from a two-speed world now. You cannot just classify developed and emerging markets. And so companies have to look very deeply at where they can unlock growth. The challenge, the underlying growth in Europe has made it more of a challenging issue.